we're going to move to asset classes. Where should we be investing from venture to public markets? And to sort of set the stage, Pepper, which is an asset tech company, is going to share some opening thoughts.
Thanks, Mark. Morning, everybody. I'm Ann Eberly-Thomas, co-founder and CRO of On Pepper. And you'll pardon a couple notes this morning. I'm pinch hitting for my co-founder, Pulak, as I speak. So great. Thanks, Anessa. So does anybody know what global GDP is within a couple trillion currently? Any guesses? 97 trillion. So it's apples to oranges to the global global AUM up there, but it just gives you an idea of the size at about 127 trillion of global AUM. And on the right is the fastest growing area in asset management, which is the alternatives. These two areas are sitting on just oceans of data, which on one side present a lot of complexity, and on the other side are just a gold mine for asset managers. And then when you add on the secondaries industry to alternatives and you get into the different layers of data that need to be looked through, it makes it even more complex. So the headwinds facing, especially the alternative industry, are the regulatory framework and the increasing competition, which requires much more marketing, and marketing in the sense of really understanding what the value opportunity is for investors. These are McKinsey charts, and according to them, the traditional paradigms of investment are being upended. And so there you enter asset tech. Asset tech is fintech meets asset management. There's a term that's actually coined by my co-founder Pulak. And so as asset managers need to show profitability to their investors, they're investing more into asset tech. But really what's key here is deriving simplicity and decision-making data from all the complexity that I mentioned before. And so data management is absolutely key. So this is a field study that we did recently. And as you can see, it shows that asset managers want to be here with their technology, but they're here at this point. And so there's a big disparity. But one of the key themes, the key recurring themes that came out of this is the need to have, as we call it, future-proofing, or as McKinsey calls it, an all-weather asset management program. And so really what's key to that is flexibility and a strong technology foundation. And so our premise is that technology needs to be built from the ground up on native cloud, because it has to be able to take advantage of the ability for efficiency and ecosystem and innovation. And so especially in the alternative world, which is, say, roughly about 40 years old, the alternative world has been extremely innovative, right? Starting with, traditional private equity, moving into private credit, moving into the secondaries industry, and choosing, different kind of marketing aspects of all of those. On the other hand, the technology that's come along has been very point driven, very functional driven. And so there has not been a connectivity, and there's just a massive amount of data leakage. And so that really needs to be brought together. And so building on native cloud allows companies to take advantage of that. They can do things like take advantage of, 1 minute, okay. AI/ML for document reading, for the loads of PDFs coming in and out, not just to read the key information they need to plug in, but to read that entire document and to be able to make sense of that and to load that into the data set that they need. I'm gonna move to the next slide since I only have about a half a minute. So AI is one of the things that Pepper is deeply investing in right now. And so just a quick summary on investment focus. I won't linger too much on crypto because it's painful for many people right now. But but really, one of the in a little bit different lens into investing in crypto and what we see as future investing in AI. In crypto, it was exciting to see a potential alternative currency, right? But in AI, the opportunity is in creating solutions that nobody even thought of before. So, when you shout out to Ohio, when you drive to Tip City, at Thanksgiving and you want to see what the traffic's going to look like along the way, you can go online and you can, on your app, and you can see that all driven by AI. But as investors look at AI ML investments, I think there's 3 key things to look at, and that is team, technology, and data. You have to have the right team with the business experience and very deep tech, and you also have to have a very deep data set. A lot of companies have 2 of these things. Very few have 3 of these things. Any time?
No, you did it. Set the stage well. And no one's really happy with lots of things, particularly their dashboard of their technology, although maybe you guys are, but we could all do better. So we'll be hearing more from Pepper. So we're going to talk about asset classes, and we're going to go, you're sort of a couple hybrids here, Brett. You're private credit, you see the private equity market clearly. You can maybe talk about that, moving private credit, but you also see the real estate market, Brian, across the US at least. And then we're going to talk about data, and a lot of it is having definitions and clarity and consistency. And that's what you're going to touch on, Joe, and is the venture markets having a bit of should have a rethink. So with that, maybe Brett, you want to kick us off?
Yeah, sure. Try to speak up there, likely be tough. Well, good morning, everybody. Again, hope you all had fun yesterday and didn't get hustled and ping pong too much. I guess the way I would start with it is, where do you want to be investing, thinking from a macro perspective, and why? So US GDP is by far the strongest of all the developed countries right now. Our view is that that's going to continue and persist. So starting kind of macro level, US economy is great. Getting more into then what sectors, as I guess a dovetail to meta and big tech and some of the other risks, I think those are likely much more volatile bets. So as far as Star Mountain focuses on, it's more businesses that are service oriented, variable cost model, low cap expenditures, and so forth, as you think about what sectors are more recession resilient. Then, so for us, that's avoiding real estate, energy, speculative end sectors, and so forth. Then you get into the balance sheet. We have a highly and one of the fastest rising rate environments since 1981. And the increased impact is dramatic for most businesses. So for us, we want to therefore be the first lien part of the balance sheet of a company that are cash flow positive companies that aren't going to rely on needing to access liquidity in a market environment where liquidity is extraordinarily tight. As people may know, lots of big banks right now are hung with tens of billions of dollars of debt that they're needing to sell at 10 to 20% and more discounts to get somebody to take it off their balance sheets, right? And this is just the beginning of a reasonably likely recession to come. So when you think about where in the balance sheet, not only being first lien, but keeping your leverage low so that you can withstand margin impact, right? That's coming from the inflation that we continue to have, that you can withstand the increased interest burden that is likely to continue to increase. And so for us, that's when you stick to the fundamentals of, low leverage, senior secured, floating rate loans. And that's a part of the segment that we like. And then secondly, our other strategy is secondaries. So in a market environment like this where people need early liquidity, and I guess maybe some of those people may have thought they had more wealth creating crypto and things like that. But when people need liquidity, need to sell, that's a great opportunity for those with capital that want to be a buyer as far as the secondary strategy where you're looking to buy high quality diversified portfolios of assets at discounts. So I guess that's a little bit macro to micro of what we do and why.
That's great. I was just telling Fiona, we actually do have diverse panels. The only thing diversity is the age levels, but
Canada count for anything?
let's switch over to credit yet real estate. How you're seeing the real estate market, Brian?
Yeah, the real estate market. So we're in the credit side of it. So we're obviously financing a lot of developers and builders across the country. We really saw a shift probably starting in the summer. I could always tell by conferences. I'm doing another conference next week, and the debt real estate panel actually has prime time location. Usually we're at the end because everyone wants to hear about investing and buying multifamily properties. So, but certainly started getting a lot more questions over the summer, and expect next week to, get a lot more questions as people try and move up the capital structure. With interest rates rising, some of the projected returns on multifamily investment properties, although obviously has some tax advantages versus debt, the returns have come down quite a bit. So when we sit there and we say, well, you could be up to capital structure with first lien security and still get 11-12% net returns, versus some of the projections aren't much different on real estate equity investments. We're seeing a lot more interest in that side of the fence. Obviously on the office side, we don't do a lot of office. We've had a tectonic shift, obviously, in the last 3 years with how people work. And that's creating a lot of havoc that I think still needs to play out over time. We see a lot of anecdotal information about people changing their footprints and redoing leases. And there's certainly a lot of debt providers in the office space that need to still work out what's going on, what's the value of those properties. So we tend to stick to, single family and multifamily assets, which, from a 90,000 foot perspective, we still have a major housing crisis in this country. And, we are starting to see some jurisdictions loosen up on regulation to start to try and alleviate that, even in the New York metropolitan area, where we focus about 2/3 of our portfolio. Politicians are finally starting to succumb a little bit on the requirements for affordable housing and things like that to make projects actually get built. We were looking at financing a project right across the river here in Queens, and the local board was mandating 50% affordable housing, which is a great thing to shoot for, but it also makes the project uneconomical. So you're at a standstill. We're starting to see people realize that things need to get built, and we need to get things built as best we can with as much affordable as possible, but it still has to work for both sides. They ended up settling on 25% affordable, and that project is finally, after 2 years, advancing forward. So I think you're starting to see a lot of that around the country, as well as people looking for solutions for, as affordable entry level housing as possible. But right now we're just seeing a massive shift to the rental market as people try and wait for that to sort itself out, with rates having jumped like they have.
So thank you, Brian. Let's segue to you, Killian. First of all, Killian was a ping pong star last night, but you straddle both real estate and venture. So talk about the European real estate market, and then we'll segue over to venture, because you're a big venture investor, but your heritage is real estate.
Exactly. Yeah. So I work for a Swiss family office, and as Mark pointed out correctly, so heritage is clearly real estate, particularly in Switzerland, but we are also looking more broadly in Europe. And what we basically saw right now happening in Switzerland, I would say overall we are quite safe, given that the financing is still being secured by the large pension funds and banks. So in that regard, it's quite positive still. However, what we definitely see, and we are preparing for that, is that obviously Germany and Austria in particular, they are struggling quite a bit. They're sort of property developers that have already gotten bankrupt or are about to get bankrupt. So we are currently looking at basically buying out their distressed projects on quite attractive actually volumes, and we've also set up basically credit facilities in Switzerland to be able to finance those. So that's looking quite good. So we see a high potential there basically to expand the portfolio, both in commercial and residential. I think that's important to mention. Because especially in cities like, for example, Berlin, there's like unfinished projects right now in prime locations that are just standing around, given that either the people have a skilled labor shortage to finalize the projects, increasing material prices, and also interest rates, obviously. So I think that's that on the real estate side in particular, how we are viewing it at the moment. I think when it comes to venture capital and private equity, so venture capital, we are very, very bullish on early stage venture capital in Germany, Austria, and Switzerland, and the broader European area. Why so? Because I think just historically, it has proven that vintages coming out of crisis, which will be 2022, 2023, can be highly successful. And we strongly believe in that. And I think there's a lot of good macroeconomic points pointing towards that. I think it's obviously is a bad sign for many affected individuals that the big tech companies are laying off so many employees. On the other hand, that provides a lot of skilled labor hiring for young companies. A lot of young and very skilled founders will be coming out of that. And I think what's really good is that a lot of the founder tourists, as we have seen coming into the industry over the past couple of years, they've vanished because they've seen, okay, in this environment, we are just not able to raise capital on like companies with no real history, with no profitability, with no actual functioning business model that is here to solve a problem. So we are very deeply looking into early stage. And then the second thing, which we also do look into, is secondaries, basically. Because there are also a lot of tourist investors in the market over the past couple of years that have heavily overinvested, or that have invested in the right way, but are now panicking and are doing panic sales, basically, particularly in tech, particularly in pre-IPO scenarios that have were set up to be this year, have now being delayed. And then we are looking into that as well. And I think lastly, what we are also looking into is distressed private equity in small and mid-cap markets. Again, I think if you have the access to those deals and the expertise in-house or with external partners to be able to turn around those companies, transform them, get minority stakes in, maybe even encourage management to do an MBO or something like that, there's also quite a lot of opportunity in the market in Europe. So.
Perfect, thank you. So we're going to transition to talking about venture and innovation. But one other thing that's happening in Europe, and it's really the cost of energy, is Europeans are building their industrial projects. They're moving them over here. You know, and really it's cost of energy and labor complications and otherwise. So the U.S. continues to be a beneficiary of a lot of these trends. The U.S., China, and Israel are leaders in innovation and venture, which we've been hearing. But let's talk about we could be much more effective in allocating in venture. So I'd like, Joe, do you want to kick off of how we should be thinking?
Is it okay if I stand too? I
You
think
can
better when
definitely stand.
I
Yeah.
just can't sit. It's either chew on a cigar or stand and move. So
Go for it.
yeah, we've got
Just
real.
Jack's going to stand. I know it.
Yeah, we got to stand. Rethinking venture capital, we're at a fascinating point in time where I think the conventional narrative of the venture model as it has unfolded since the first fund was launched in 1959 is finally changing. Can we hear? There we go. Sorry. Tom Nicholas, professor at Harvard's Business School, wrote what's probably the best history book on the venture industry. If you haven't read it, I'd encourage you to read it. It's called VC, An American History. And on page 311, he says, it's ironic that the very industry that purports to fund innovation largely hasn't innovated since the first fund was launched in 1959. Right? Sequoia just announced they're changing their model. And this was their quote last October. As chips shrank and software migrated to the cloud, the venture industry is operating on the business equivalent of floppy disks. Holy cow. And then Clayton Christensen's firm, InnoSight, his consulting side gig, was hired by a deep pocket in Asia, I believe Singapore, to study the venture industry, a classic consulting analysis. And they put out a report in 2020, late 20, called The Future of Venture Capital. And it talks about all these things in a very objective consultant analysis. So essentially the industry and the model is changing. And I think with the headlines, and having been around for a long time in this world, these headlines are just repeating themselves. They're just echoes of what we saw in the 90s. My quick background is I joined a money management firm right there at 3000 Sand Hill Road in 1990. My boss his firm was purchased by the bank in Liechtenstein in 1988. He was the boutique money manager in the Bay Area. Classic profile, old San Francisco money, Ivy League undergrad, Stanford MBA. Entered the RIA industry in the mid 60s, started on from 1970, sold at the bank in 88. I joined in 90. And he ended up dying of cancer and I took over the business, bought it back from the bank in 93. But we were right there in the belly of the beast.
The first portfolio I was handed when I joined Denny's firm was Larry Cincini's personal money and the two Sequoia partners, Pierre Lamont and Sven Simonson, because of who he was and his background. But it was also that era, that pedigree. The parking lot of 3000 was half empty. Right when I was there, it wasn't cool to be a VC. All the biz school rock stars went off to consulting or investment banking. And then the internet commercialized. And the Band of Angels was founded in my office by Hans Severns, my subtenant. The Angel of the Year Award and the Angel Capital Association is the Hans Severns Award. Well, he was dating one of my clients. So I just had an ironic series of experiences and exposure because of who my boss was, where I ended up landing, and when we were there. But we were institutionally rigorous, old school securities analysts. And I got active in the Band of Angels, one of the earliest members, and then eBay Angels when that group exploded. I was the 9th member and it became 120 members, seeing 3 deals every 2 weeks at eBay's headquarters from deals that were traveling to pitch eBay's venture arm. One of the guys on the eBay's venture committee. So saw it from the belly of the beast as a money manager that we did our own securities research. And I went, wait a second here. There's process orientation. There's data available. I mean, I didn't have to have the managements of Cisco and Intel come pitch me in my office before I decided to buy the stock and put it on our clients' portfolios, because we had data and we knew what to do with the data to build an investment process. So the major low-hanging fruit in the opportunity to improve how we fund innovation is to bring process rigor to the very process, bring some meaningful innovation in how we fund innovation. And there's a lot of lessons to be learned. And we're going to discuss some of the research. David's done a great job. I'm going to let them introduce themselves. But David's done a great job at accumulating a lot of the research out there, and it's on his website if you haven't seen it. I follow his stuff all the time. I have for years. We just met yesterday. It was wonderful. There's a ton of academics that done some great work. 500 startups got some data scientists, did some great work. So there's a lot of research. And in the breakout later, we've got some compilation. I've got some stuff that I think David doesn't have on his, or he might have it by now. But we've got some links to the actual research that we're just going to use and discuss about how to rethink venture capital so that essentially entrepreneurs have a lower cost of capital, a more efficient process. We're deploying innovation capital properly, and LPs can have more confidence in there's going to be repeatable alpha available. It's not going to be episodic. It's not just going to be what's hot, and hopefully we got it right. Otherwise, we're going to keep repeating these same bubble patterns that we keep going through, while the heroes, the entrepreneurs, continually face the brain damage of doing the hard work, building the company, and then trying to source money from folks that are a large part tourist investors. And that includes VCs, by the way. So we're going to step on some sacred cows here. So why don't, David, why don't you introduce yourself? We'll have Jack, we're going to focus on, and then we'll take some comments from our other partners up here as well.
Thanks so much. So I'm testing. Okay, good. There we are, much better. So I'm David Tedden, based here in New York. I was previously a partner at FF Venture Capital and managing partner at Hoff Capital. Hoff was anchored by the Sawiris family and has grown to now 1.2 billion AUM, LPs from 37 countries. And I launched my own VC firm a little while ago called Versatile VC. And we specialize in investment technology. We think we're the only VC in the country doing this. We're investing in companies that help investors generate alpha and grow. So that includes alternative data, companies like Earnest Analytics and Drop Technologies, back office tools like Adapar, where we were an early investor, which hopefully some of you use, which helps family offices take the messy data sets from various investments and bring it in one dashboard. Companies like Stratify, which brings sophisticated risk management to retail investors so they can give more sophisticated thinking to their investments than just the high risk, medium risk, low risk tick box that Fidelity normally gives you. So we've been studying this innovation venture for a long time and living it. And we see huge opportunity to raise the bar. I will generalize the point that you said earlier. It's not just that VCs are behind. I'll point to my brethren in private equity. I was talking with a friend at a well-known top 10 global P fund. They don't even have a CRM system that all the partners use because the partners want to keep the data on their own phone and don't want it accessible where everyone else can have it. Brett tells me he spent $20 million on his own technology stack. So there's certainly forward-thinking private equity funds and lenders, but they are the minority. And I hear horror stories from the inside of these major firms. I don't know if it's too much. Brett can comment on that. Okay. So we think there's opportunity for us as an industry to raise the bar, to do this more effectively, to get better returns. And from my point of view as a VC, we're investing the tool providers to the sector. I launched a community called PEVCtech.com. We're a partner with 361, which we appreciate on today's event, focused on helping people like us use data and analytics to increase returns. We think that just as in the public markets, there's been an evolution towards firms like D. Shaw, Two Sigma, Renaissance, which look more like software companies than like Warren Buffett using a pencil going through a 10K. We think in our world, in private equity and VC, you're going to see more players who look like that and are using technology, data analytics rigorously in order to generate higher returns. That's our story.
Dec, why don't you go?
Speaking of rigor,
Yes.
you can stand too, Jack.
You're younger, but you do this. We can charge by the click.
Yep.
So obviously it's notable that I'm the only one who stood up and buttoned his jacket. I have an objective for this group this morning to sensitize everyone to a subterranean part of the venture world that generally doesn't generate much attention, didn't show up on Ann's fancy charts. And it's the institutional angel world. There are 262 institutional angel groups in the United States, organized under an entity called the ACA, Angel Capital Association. And those organizations, as distinguished from random dinner groups or other informal angel groups, of which there are many, many more with thousands and thousands of people, those firms or those groups, as a general rule, follow a highly disciplined, rigorous diligence process, about which there's been considerable commentary about the lack of within the venture and private equity industries. But it's interesting that these angel groups, institutional, do so and in a rigorous manner that would be surprising to all of us who are here. It surprised me. I spent over 40 years, have spent over 40 years in the venture capital business, founded Blue Chip Ventures, which is based in Cincinnati. We invested about $1 billion in 220 companies. And it was a fascinating period of time. The last 15 years, I've been a member of Queen City Angels, an angel group obviously domiciled in the Queen City, which is Cincinnati, Ohio. And it's on its 6th fund, 22 years of experience, 190 members who engage every third Monday for 3.5 hours in the kind of rigor that I just referenced in determining what companies to assess, what companies in which to invest, and then how to build those enterprises. And the first 5 funds over these 22 years have generated 2.7x in the aggregate return. The 6th fund, which is currently has 35 companies, so it's a well-developed fund that's in its 3rd year, is tracking on a 5 to 6 times return, which is directly attributable to an enhanced diligence program that this firm put into place, or group, it's really not a firm, after
30
a
seconds.
20-year period of time.
30 seconds.
So there's this world of institutional angel groups with meaningful results, a rigor that various of us are yearning for in other sectors. And it's all there, but it's so subterranean that it has little to no visibility. And Mark, I think an interesting initiative for 361 to undertake is to create a fund of funds under the 361 umbrella and put capital into the top 10 of those 262. And
That's the plan. You're just making it your plan now.
well, no, well, thanks for telling us all about the plan. So the one that I'm exposed to, Queen City Angels,
Jack,
is number two.
We need to, I want to open it up for some
Yeah.
Q&A.
Jack. We were warned about Jack and he knows it.
Listen, what was my objective? It was to help others. I don't care.
So look, I want some Q&A. You've heard a lot of themes from different parts of the capital stack. Rigor is important and all the rest. And the other thing that you actually left out is that these angel groups actually mentor and support companies, which I'm not so sure you were seeing that. I know you would have. What about questions from the community on asset classes? And by the way, the next segment is breakouts and lunch. So there is food coming. Yes, all right.
I was hearing that there's changes going on in the VC world. What about the problem I always have is the lack of liquidity. You're talking about at least a 10-year time frame and then multiple additions to that. So is there any talk about potentially changing that?
Yeah, there's a number of firms that are creating a secondary market and real almost NASDAQ-like equivalents for this asset class. There's movements to put 40 Act wrappers around properly diversified venture portfolios with a ETF-like thesis focus, so that not just the accredited, but the Title III Jobs Act, the proper execution of the Jobs Act can allow non-accrediteds access to, but better architected venture exposure as an asset class, not a random crowdfunding, hey, gamble your money away sort of thing. So there's a big movement on this. There's infrastructure players taking place, putting in the actual infrastructure. I call it adult supervision. Take it out of the tourists and the hobbyists and the inefficient market, let's call it that, in information flow coming from startups, the corporate governance practices expected of startups, right? It can't be the Wild West anymore. Otherwise, we're going to keep repeating the same patterns and the same problems: illiquidity, episodic alpha, right? And a high cost of capital for the entrepreneurs. You're not in Silicon Valley, New York, Boston, LA, and maybe now Chicago, notwithstanding Austin, where I'm at. Trust me, it's veneer thin, the depth of money and the depth of financing infrastructure. So
Anyone else on secondaries?
I could also add to the liquidity point. So let me tell you one of the great failings of VC as an industry. Kaufman Foundation looked at the Inc. 500 companies, fastest growing companies in America. Do you know what percent of them raise VC? 7%, right? So that to me is a great failing. My job, my industry's job is to invest in the fastest growing companies in the country. And we managed to penetrate a whopping 7%. So why is that? Because VC as a financial structure works for a certain small subset of companies. It doesn't work for lots and lots of others. So there's this gap in the market, right? Once your company gets to a certain level of scale, you can borrow money from Brett and his peers, right? But if you're a young, small company and you don't necessarily show the potential for super fast growth, and you as the founder don't necessarily want to dilute yourself to minority ownership, right? Typical founder at IPO is 9% ownership. Then where do you get money, especially if you don't come from wealth? So there are people experimenting. I really like the revenue-based finance market. That market, which I think is around now 5 billion AUM, has grown faster than traditional VC. And yesterday we had presented from Europe, one of the major players in that space, round two capital. So I see a lot of room there for innovation. And there are other firms like Indie.vc, which have pursued some creative ideas in this space. So we're very interested in the alt VC model, which can help to generate early liquidity, to your question, and help to fill this huge financing gap.
And speaking of secondaries, you're doing something that's unique. It's like you're either buying LP positions or you're buying loans. You're buying both.
Yeah, we like to start with the U.S. lower middle markets, the fastest growing segment of the U.S. economy by far on a revenue basis, and you can access it in a value base. So it's a lot easier to make money when you have tailwinds versus headwinds. And within that, we will buy portfolios of assets, limited partnership interests. We will buy direct assets. And so we look at around 3,000 investments a year with our 100-person team, and selectively invest in with 3% of them to try to make the absolute returns, and as well as build diverse portfolios.
I also wanted to recognize that I had an interesting conversation on the subject of alternative approaches. I had a great conversation with Philip Benjamin, who I think is going to talk to us a little bit later about another scenario that his family has created to address the need for the issue of liquidity. So wait for that in the breakouts.
Other questions, comments?
I'd comment one thing on that, just from my perspective, and love to hear people's thoughts, but just having managed a private debt fund that was in a public vehicle, and witnessing the process that goes into marking to market those investments. So one thing's never going to change in VC. The time it takes to invest in a company and grow that company to a point where it can have a natural exit. Nothing can change that, right? It takes time. So if you want to wrap something into a 40 Act, I mean, secondary market sounds like a great idea. Obviously, you have to figure out how to value it, but how do you value that company midstream? And I would just say, from my perspective, love to hear Brett's as well. I've lived in organizations that have to do that for debt, which is a heck of a lot easier than doing it for a company, a private growing company. And I've seen the issues that creates in trying to do that in vehicles to provide, better liquidity or more liquidity. So I think that's a pretty tall challenge that that's going to be pretty difficult to overcome, but love to hear what your thoughts are.
And this is, hello, there we go. There's a lot of questions on why the venture industry has continually repeated the old bad behavior, and it's not a profession. There is no formal licensing, no training, no body of knowledge they have to study to go. Like hairdressers have more rigorous professional standards than VCs have. There is zero barriers to entry. And people say, well, why is that? Well, I put the squarely on the NVCA. That's a lobbying organization. They should have established these professional standards, a body of knowledge, the research coming out of academia and stuff that David's accumulated. There should be a certified venture investor designation and curriculum. There's KIA, there's CFA, CPAs, lawyers, doctors. I mean, professions have proper training and requirements, continuing education. One of the overlooking things that's been overlooked in that absence of professional body of knowledge to study is called the Bell-Mason diagnostic. I encourage you to look it up. It's all over Google, but it was partially designed, architected, and back tested by Coopers and Lybrand to create a gap equivalent for early stage reporting. Now, it's been long since used in the corporate venture world because they're more of a process-driven, fiduciary-driven pool of money. Who's running that corporate venture for Shell has to report to the CFO and the board. So they have to have process. They have to have tools. It's not a 2 and 20 incentive model. And they've been using the Bell-Mason diagnostic for 30 years. So there are lots of resources to actually implement professionalism in a lot of these processes to build the infrastructure to create efficiency. A more efficient market is what we're talking about. And these efforts are being built as we speak. And so, yes, there are tools. They've been out there a long time. They're now getting incorporated and indoctrinated into the tools and the infrastructure to create a more efficient flow of capital so we can have a lower cost of capital for entrepreneurs and more repeatable alpha for the LPs that are willing to invest in innovation.
And I think from a secondary perspective, I think it's going to be very hard to really build efficiency within venture. If you look at the statistical returns of venture capital over the last 30 or 40 years, it's very difficult. It's hard to stay within top decile performers. The way you're analyzing the success of a business, McKinsey recently came out with a report and they attributed 60%, 60 of the probability of success of some of the fastest growing companies in the world to the CEO. And therefore, data can't really tell you that. It's really the personal relationships, as was talked about before, getting to know people, understanding them, being able to be good at evaluating people, thinking about the business plans, knowing the industry. So for a secondary buyer, that's just practically very hard to do. We get offered, for example, the ability to buy venture capital positions in huge companies and small at 50 and 75% discounts. We're hard passes on that because it's not clear that that'll still make money. And so other than pure play VC folks that are trading within portfolios of assets and names and people that they know, I think it'll be very hard to build efficiency into it. So those are the folks that be best geared to do it. Whereas within where we invest, for example, we look at our average companies have 30-year operating histories. We get to look at customer trends over decades. We get to look at profitability. We get to, talk to customers and say, are you going to grow with them, shrink with them? Why? You get to evaluate management teams, see that they're good operators, not just people that have a great idea, but may or may not be a good operator around it. And so I think that venture is it's a very hard asset class that way to get right. And then to the question of time, your average fund lives now are getting to 13 and 14 years, which is not for the faint of heart as well for a lot of people. And I would actually expect that's going to continue over time, especially with where valuations have been, to the extent that they don't go bankrupt, continue to try to push them forward to not have to write them down. So I think venture will be hard to bring more efficiency to from that perspective, as what we see in the secondary space.
Can I offer one piece of spice on that? This is
Female perspective.
oh, please.
Well, first and foremost, I think I'm just a human. So there we go. We're all human. So, but I wanted to just empower and bring in a visionary on the aspect of impact investing. I've had that opportunity to be a VC in a sector that takes risks that you guys haven't taken. So there you go. And that is the core quest I place in the environmental social governance. And what are the metrics you're using to measure success and how you're impacting different individual lives as well as diversity, since you wanted to bring that quest in there. So I wanted to just bring up, for example, there's a report. I've been a Tonic 100% member for many years. That's a family office group called Tonic, but in there we have a report that's called the T100 report, and it really looks at the United Nations Sustainable Development Goals. And what we did in that report is we've wrapped report 1 is 27 families, and we have about 2.9 billion in that asset holding, all camouflaged who the families are. But the core quest that I place for you is to use it as a measurement tool to also look at your personal choices. I mean, we live on this planet once. What are we doing? And what are the choices that we want to take risks? And as we push into VC funds, I get much better fund return daily or weekly in my micro loans that I've done in multiple countries, because people pay back every week. And so I'm pointing that to where are your metrics? And I ask you to also bring in your environmental and the social governance. And when we look in the European markets right now, we've forced ourselves to have to prescribe to a set of really environmental rules using the United Nations Sustainable Development Goals. Where are we in America? We might have the UN here in New York, but how are we participating and what are our quests? So that's my thoughts.
Yeah, if you want to give you 30 seconds. So Star Mountain managed over $3 billion for public pensions, insurance, hundreds of family offices and so forth, internationally and domestic. We have investors from over 30 countries around the world. We're signatories to, CFA, everything from diversity inclusion to others. And we actually build talent. We have a junior talent development program that builds women and minorities into the space because they need to be given chances and educated. And I know people talk about diversity in different ways, but my mom died of cancer when I was 5 years old. My dad's a retired high school teacher in Western Canada, and I worked on the oil drilling rigs for a year to pay for college. Now, no aspects of my background are called diverse. But if you look at the challenges that somebody from my background, the probability of achieving a type of life versus how many friends of mine are already dead at the age 44, you might be blown away. Within our portfolio at Star Mountain, which includes managing money for the U.S. government under the SBA's regime, over 60% of the businesses that we're invested in are in what are deemed a low and moderate income area within the United States, and back in helping support people across America, not just the companies that may or may not be, a high flying front page technology company, but, good old fashioned middle America, people that need businesses. So that's the way that we tackle the way that we're investing in different sectors from Star Mountain's perspective.
Anyone else?
So I want to push back a bit on something Brett said, which is you were skeptical of how we could use data and analytics in VC. I could speak at length for this, but let me highlight a couple of things. First off,
Said liquidity.
liquidity.
But are you addressing Fiona's question too?
So to your question, so look, you can't manage what you're not measuring, right? So one of the opportunities that I see here is there are a variety of data vendors who are selling ESG tracking. In other words, they'll track performance of a given company against your ESG goals. So you can't credibly claim that you're an impact investor without defining what that means and tracking data about your portcos. And why should you do it if there are vendors who can do it with this efficiency of doing it across multiple companies? So I think that gets to your point. And if you want to hear on some dispute between Brett and me, then we can talk offline about that.
Yeah, I've been involved in the impact space since I ran the multifamily office, going back before, I was reading Calvert's socially responsible prospectuses 30 years ago. And actually, institutional investors at a Journal of Impact and ESG asked me to write a piece for the January edition on this topic. And the question is ESG, and you could put impact in there as it's its sister or cousin, is it legitimate? And I started writing the piece, framing it in the context of the telos, logos, mythos, ethos, pathos, right? And what's been largely screwed up is, as Wall Street has a love to do, is to go sell stuff without an authenticity in the execution of the management. I go back to Calvert as well, as there was a lot of greenwashing in their marketing. When you read the prospectus, it was just trade off between Chevron and Exxon. It wasn't real serious stuff. The fact is that qualitative motivations are part of the human condition. Look how much money is given away to charity, right? People do care where their money goes. And there needs to be better execution, better pathos and logos in the execution of impact and ESG. But the fact that there's no question that's a legitimate agenda, and it's become more urgent, I think, is really the summary of your point. We just need better execution in so that logos, pathos, and mythos are all aligned. So
And I don't think there's any big firm out there, frankly, that's not acutely focused on it, for sake of clarity.
Well, we're watching. How's that? It is a question. And when you look at environmental governance and the social side of it, what paramount time is the law and how much of us or those companies, that's the risk sector in the real estate side, where right now I'm involved in tapping oil wells. I mean, I would never have thought that I'd work with people to do oil regeneration, but it has to be done.
Yeah.
Or decarbonizing shipping. I invested in a shipping company that does technology to actually lower the use of fuel. So I think that we have to look at if you have a choice of a seed investment, where do you place it in a VC sector, and then building a portfolio around it, following what you want to do, making sure you work with great people to do it together.
So just a couple comments. We are going to have the fourth round is about impact interests, right? And there'll be a panel. I'm probably going to bring you onto it.
Come join our 361 firm community of investors and thought leaders. We have a lot of events created by the community as we collaborate on investments and philanthropic interests. Join us.